Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by the resplendent Jimmie Lenz. Good morning, sir.
Good morning, Lee. Wow, kind of a fall-like morning here in North Carolina. Kind of cool and wet, and I know part of it's from the hurricane offshore,
Yeah.
but man, it's starting to feel like fall here.
It is. It's a dreary Monday morning for sure. But we got a lot to talk about.
A lot to talk about. This hot in the digital asset space.
In the digital asset space. So I hope folks enjoyed our deep dive on the Gemini S1. Today, we're getting back to our regularly scheduled programming and tokenization, right? I mean, an episode does not go by without us talking about tokenization.
Yeah.
And I wanted to start, Jimmie, with a blog post, interesting blog post from some folks at the New York Fed at their Liberty Street Economics blog, which is a fantastic resource. I'm a pretty regular reader of that because we talk a lot about tokenization, Jimmie. And I think in those conversations, not just us, but like when you read about it and hear about it in other contexts,
Sure.
like, it's just sort of taken as a given that it's good. But like, I don't think a lot of people actually explain like why it's beneficial or what it's useful for other than like 24/7 trading. Right. And I've asked you about this a couple of times, and you've provided good answers. But this blog post actually looks at tokenized investment funds. And, this is one of the very big early use cases, right? And we've talked on this show about BUIDL, which is BlackRock's tokenized money fund. Now, it's not
money market.
It's not money market type fund, because as the blog post highlights, the use cases thus far are either what they call private funds, which is what BUIDL is. So you have to be an accredited investor to access it, or a public, a 40 Act fund, a money market mutual fund, right? Which is subject to public disclosure requirements. And, BUIDL is by far the biggest. So it lays out, BUIDL has AUM of $2.5 billion. But for the public money market funds that have been tokenized, Franklin Templeton's, they have FOBX, and if I'm butchering these acronyms, I don't, I'm sorry, let me know. 708 million assets under management. Circle, we've talked about their with Hashnote, so they have USYC, a tokenized money market fund. They have a little under 500 million in AUM, and then Wisdom Tree bringing up the rear there with their tokenized money fund at 10.8 million. So again, BUIDL takes the cake. Okay,
Right.
And so they go into use cases, and I'd be curious to get your thoughts on these use cases, because these are kind of the things that you used to do, Jimmie. When you were in the markets, right?
In the business.
So in the business, so use case number one, development of a secondary market and instantaneous liquidity pools.
Yep.
So in essence, you can use your tokenized share as a medium of exchange in secondary markets. Now, I kind of remember back in the day, Jimmie, that some money market mutual funds would let you write checks.
Right.
Now, I think
against your account. Yeah.
Against your account. Now, that's since gone away. I think the SEC rules have addressed that. But at least in a digital asset economy, you can use your shares as a form of payment. So they give the example, actually, of the smart contract controlled pool where BUIDL and FOBX are instantaneously exchangeable for USDC.
Yeah.
Right?
I mean, if you think about it, I mean, it's like one of the greatest things there is, being able to do this. So think about being able to keep all of the money that you're going to use to pay bills and things like that in an account that yields money market fund type rates. Right now, you can't do that because a money market fund, people forget this, I think, a lot of times, are mutual funds. I mean, that's what a money market fund is. It really is
it's money market mutual fund. Yeah.
It's a mutual fund. And so you have all of the, kind of the slowness that is associated with mutual funds. You have to wait until they close, and they really only trade once a day. And, then you have to wait a couple of days to get your money out. And it's kind of a pain in the butt. You have to be, you can't just do things on the fly. You have to be preparing for it ahead of time. And so the idea of using this is what I always thought this is why everybody would use it, is like you would, instead of putting cash into a checking account, you put it in one of these. It's like the greatest thing ever, being able to do this and preserve that yield that, hey, somebody's going to get that yield no matter what. Might as well be you.
Yeah, that's right.
Huge fan of that use case. I think that's to me, that's kind of the front and center use case.
Yeah, that's okay. And that's probably why they listed it use case number one.
Probably.
Okay, use case number two is reserve asset for DeFi-based products.
Yeah.
So I think the classic example would be like a stablecoin, right? We all know the whole premise of stablecoins is that they hold a basket of high-quality liquid assets in reserve, right? That, underpins a one-for-one with the US dollar exchange value. So why not have tokenized funds, shares in tokenized funds be reserve assets, right?
Sure.
And so the example they give is Ondo Finances, which I'm not all that familiar with Ondo Finances. I know of Ondo, short-term U.S. government treasuries. So recently, Ondo announced it would exchange shares of OUSG for shares in 4 tokenized money market funds, and they plan on holding those shares as part of the reserve assets. And BIDL will be the biggest one there. Okay.
Yeah, I mean, it just makes things a little bit smoother, a little bit easier, and honestly, it probably is a little more efficient at the end of the day than doing your own trading and having your own trading room. You can use these as assets to back as something that is required to be backed 100%, as you said, like stable coins. These are a lot more liquid. These are easier to deal with. Otherwise, you have to set up a trading desk and start managing, treasuries, and who wants to do all that stuff, right?
Yeah.
If there's an easy solution, and this is kind of the easy solution for anything that needs some kind of stable backing. So, I mean,
Yeah.
this kind of goes along very logically with the first use case.
That's right. And the third use case, Jimmy, is collateral for derivatives.
Yeah.
Okay. So you could use your tokenized shares as margin for repo and derivatives. So the blog post references a Bloomberg story that indicates two of the world's largest crypto prime brokers allow clients to use BlackRock's BIDL as collateral for crypto based
Yep.
derivatives trading. Circle recently purchased Hashnote, as we noted, the issuer of a tokenized money market fund, for the express purpose of have that being a form of yield bearing collateral on crypto exchanges. And then it also references JP Morgan Chase has facilitated a transaction in which tokenized BlackRock money market fund shares were pledged as collateral with
For collateral.
Barclays
Yeah. I mean,
for a derivatives contract.
it kind of makes sense, you know. I mean, people don't. I think sometimes when we're thinking about all of the things that go on in derivative transactions, or and sometimes they're not like exotic derivatives or anything like that. They're just very very upfront. Maybe even like futures contracts or something like that.
Hmm.
There's a daily kind of check that you can either receive some of your collateral back, or you have to post additional collateral. Allowing collateral to be posted like this, I mean, kind of makes sense. The other thing is, you often have to put up reserves to write certain kinds of contracts and things like that. In other words, you need backing of
Hmm.
some kind of financial backing. So if something went bad, there's collateral to stand in back of what's
Yep.
essentially a contract that provides a lot of leverage to the users. And so this is a way to kind of counter that. And so yeah, I mean, those are very 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 obvious, I think,
Sure.
ways to do things. And they're not even talking about they're talking about, okay, these would facilitate this in a really really good way. I mean, the cost savings is probably pretty substantial in these too, when you think
Yeah.
about how prime brokers work, and all the middlemen that are involved and things like that. I mean, I could see, when I read this, I was thinking about, other kinds of collateral and things like that.
Mm.
And the way that we manage, way shorts are managed and other kinds of collateral. I could see this really going in and revolutionizing that. I mean, there have been so many people that have tried to, update borrowing, in particular for shorts, because shorts are, you have to borrow the shares, obviously, and you have
Yeah.
to keep a record of them. But all of those shares have unique, much like tokens, are unique in that they have different borrowing costs. The costs can vary, after the loan's made. Oh, there's like a million different things here, and so it would seem that these would be probably an easier way to do it, and probably eliminate a lot of the frictions that go along with some of the borrowing.
Yeah, and all three of these use cases are still very small, right, in the
Yeah,
big
yeah,
picture of things, right? But I think it just gives a helpful window into what could be and what's sort of driving some of the momentum here, especially around the potential for tokenized money funds, right?
right,
Because you could say, well, look, anyone can go on, on Schwab and have access to a whole bunch of different, money market mutual funds, right?
sure,
And from an like if you're just looking to pick up a little extra yield, like that's fine, right? This blog post is indicating a broader series of use cases that are going to be a benefit to institutional investors primarily, right? So I think it's just helpful. It was really helpful for me to kind of better understand what are some of the benefits here
yeah.
to tokenization. So hats off to the folks at the New York Fed. take an eye on that.
I'll tell
Related
you what,
story. Yeah,
I'm going to put a plug in for all of the feds. I mean, New York Fed is really good, and we see stuff, and they're putting out a lot of
yeah,
things like this.
yeah.
The
Former
St.
employer,
Louis Fed, again,
Fred.
they have their own think tank basically there, and they
Yeah.
do a really good job. I know we're going to talk about some stuff from Kansas City Fed, but the Fed banks, I'll tell you, they are a really, really good source of information. If people are ever looking for what I consider pretty objective and well researched information, check out the Feds. I mean, they do a really good job.
And yeah, I mean, the Federal Reserve System is the largest employer of PhD economists in the world. Some would say
I
that's a
did
bad
not
thing.
know that,
Yeah,
but it makes
yeah,
sense.
yeah, for sure. And yeah, you're right. They all put out just fantastic research. The research departments are insulated, so they're not pushing any particular agenda. I mean, you may disagree, as we often have, I think, on some of the research pieces, but it's not motivated by by anything other than just what they think is high quality work. Okay, Jimmy, I want to stick with a related story here
Okay,
on the regulatory front, right? Because in the article didn't touch on that. And by the way, that Liberty Street Economics blog post we just talked about, there is a second part two companion piece that talks about the financial stability implications of those use cases, right?
right.
And it's pretty balanced. There's kind of benefits perhaps to financial stability as well as some concerns that they raise. So take a look at both of those pieces. But on the regulatory piece, Jimmy, especially on the collateralization front,
Right.
the CFTC is making some inroads here and is trying to accommodate that use case.
Mhm.
So last week, CFTC acting chairman Caroline Pham announced that the CFTC is going to launch an initiative for the use of tokenized collateral, including stablecoins in derivatives markets.
Right.
Now, not a lot of details at this point. Okay,
Yep.
so we'll have to keep an eye on this and how it evolves. But she gives this quote. She says, "The public has spoken." I don't know if that's necessarily true. Some people have spoken. Tokenized markets are here and they are the future. She said that she thinks collateral management is the killer app for stablecoins, and they are working towards that. So I don't know specifically what needs to change within the CFTC rulebook or what could change. Obviously, that's part of the initiative here.
Right.
But, it's kind of odd for a CFTC, for a regulatory agency press release to include quotes from executives in the crypto industry,
Yeah.
but nonetheless, they are working very closely with folks who are pushing for tokenized collateral.
Well, this is kind of what I was just talking about. This idea
Mhm.
of
Sure
using, and
is.
I'm assuming this is where she's going with this collateral for derivatives and being able to meet collateral obligations and things like that, i.e.,
Yeah.
margin calls for using digital assets. I mean, you got to think. I mean, it's going to be faster. It's going to be a little bit cleaner. And if they're stable coins, they're stable coins. I mean, we
Yeah.
don't really have to worry about a big, volatility or anything like that. And so, I mean, it just seems like kind of the logical progression of things to accept these for people that don't realize it often. And I mean, Lee, you've seen this. Will when we talk in finance about posting collateral, usually it's not just cash, right? We talk about you can post high quality bonds, you can post treasuries, you can post different sorts of things. It's not just
Yeah.
one thing that you can post. They usually give a little bit of a leeway there as far as the different types of collateral. The one thing they all have in common is they're not volatile assets, right? This is why you can post them as collateral. And so I'm not surprised. I'm a little bit surprised at the announcement, but I'm not surprised that that they're kind of going in this direction.
Why are you surprised about the announcement?
Just that that comes out like this, it doesn't come out in a little bit more full manner.
Yeah.
It's not given, it's not giving some,
What are the and I know you're not a lawyer or a regulatory expert per se, but, like, what from an industry perspective, like, what would you want to see clarity on from your regulator, right? Because obviously the CFTC regulates commodity derivatives. We're talking about derivatives, collateral and derivatives markets. Like,
right,
because obviously the issue with collateral is that you have to perfect that interest, right? I
right,
mean, if you can't seize it, if you can't take it and liquidate it, it's useless, right? It's
right,
not, it's not performing its function. So I suppose that is kind of one area of consideration, right? Which
right.
is like, how do you perfect an interest in tokenized collateral?
Well, I think it's going to be sent just like any other collateral. It's going to have to be posted. In other words, it's going to have to, it's going to have to leave your possession, which does for all collateral. So the thing that I think for
But it'll
and
be on
from
chain, right? So it'll just be, you send it on
yeah,
chain
you
to,
just send it. Yeah.
yeah.
And it would
Okay.
go from one party to the next. So I think that, for me, what I would like to have seen is some specifics here, around the type of collateral and that kind of thing,
Yeah.
rather than just
Yeah.
the general, because this is a huge market, right? The CFTC oversees a really, really large market. And when people
Oh,
think
yeah.
about, futures trading and things like that, typically people think about commodities, right? But that's not really where all where the
Rates.
action takes place, is
Yeah. Rates,
actually in
FX.
in
Yeah.
yeah, in rates and things like that.
Yeah. No, there's an old adage that the CFTC is the most important regulator you've never heard of.
Yeah,
And I think that is true given the size of the market. So I don't have an issue with this, an issue per se. Again, light on details here. So we'll see what direction it takes. But given those use cases we just discussed from the New York Fed blog post, it does make sense for the CFTC to be looking into this. If this is where the market's heading, hey,
I think so.
how can we provide some guidance to help make markets more
Well,
efficient? So
it's funny. When I talk to people in industry now, and I do often, the I mean, one of the things that people think about when they're talking about different kinds of assets is, are they marginable or not? Can I use these as collateral? Because nobody wants to hold assets that that you can only do one thing with. That it can't be used for other purposes. They
mhm.
tend to get very expensive to
Yeah,
do that, to tie capital up into something that's not marginable, for instance. And so, because of that, guess what? The cost of doing business in those asset classes tends to be more expensive. Has to be, right? Because there are other things people could do with the money that would be less onerous, and so, and maybe even have
that's a good point.
a yield. And so, this idea of being able to perfect these different types of uses, as it becomes more prolific, I think it's a logical way to go. They're going to have to give. People may think, oh, well, they're going out on a limb here, but
Yeah.
they're going to have to do this. I mean, this is a kind of normal course of business for these regulators.
Yeah. No, that's right. Okay, let's move on to another blog post from the Kansas City Federal Reserve.
Kansas City
And
Fed.
this is a blog post that is dissecting data from the Federal Reserve's Survey of Household Economics and Decision Making, otherwise known as SHED. So, this is a
Yeah.
pretty well known annual consumer survey. And since 2021, this survey has asked questions about cryptocurrency ownership and purposes of ownership. Now, look, there's obviously a lot that can be said about surveys in many contexts, right? And there's statistical validity there. But, nonetheless, it's an unbiased source of information.
Mhm.
Is it as robust as we like? I don't know. I mean, I haven't looked into the methodology and the numbers there. But I think we've always been trying to wrap our heads around, well, how many people are using cryptocurrency? The industry puts out their various polls and whatnot to kind of give an inflated view, in my opinion. And this survey is really saying, look, not a lot of people are using crypto for payments. Okay, and
Right.
this blog post is really about using it for payments, not as an investment, but using it for payments. So it indicates that the share of U.S. consumers who report using crypto for payments, okay, which includes purchases, so buying goods, services, um, money transfers, so sending funds to family or friends, or both, has been very small and has declined slightly in recent years.
Yes.
So it's declined from nearly 3% of respondents who said that they use crypto for payments in 2021 and 2022 to less than 2%
Hmm.
in 2023 and 2024. So the share of respondents who report using crypto for payments has actually gone down. Now, the decline in the share of people reporting they use crypto for payments is mainly driven by a decline in the portion of consumers who say they use crypto only for transferring money to friends or family. Okay.
Right.
So that is where you've seen the biggest decline there. Before I turn over to you, Jimmy, quickly, they break it down by demographics
Yeah.
too. I think this is not a surprise. We've highlighted this fact in other surveys we've commented on. Racial or ethnic minorities, especially Black and Hispanic consumers, were more likely to use crypto for payments than white consumers.
Yeah.
But those shares was also declining. And then I thought what was really interesting is the reasons people gave for paying with crypto. So the distribution of the main reasons consumers use crypto for payments has changed between 2022 and 2024. So the top three reasons in 2022 were number one, the person or business receiving the money preferred crypto. So that's the payee's preference.
Right.
Number two was to send the money faster. And number three was privacy. In 2024, that payee's preference became by far the most cited reason.
Yeah.
So 35% of users cited this reason as why they were paying with crypto. Now, they didn't really elaborate on that. And that's kind of what I wanted to get to your thought. I mean, so this is saying, you know, a merchant, a friend, someone is saying, hey, I want you to pay me in crypto.
Right.
And that proportion has gone significantly up
Yeah.
in terms of the stated reason here. So, what are your thoughts here, Jimmie? I mean, I think again, this is looking at consumers. Is
Yeah.
this emphasizing kind of the theme that maybe we've been getting at, that when it comes to stable coins, maybe the main action is on the institutional side?
I think I think it's a big part of it, Lee. I really do. I think institutions are seeing the value of this, and that happens often. Institutions adopt things before consumers do. Although consumers were early to the party here, there are, I think, a couple of things that stand out. That and I I mean, we had talked about this probably a year ago, 6 months ago, that I was seeing, especially small businesses, asked to be paid in stablecoins.
Mm,
I think that for them, this is a way to actually get paid quicker and get access to the funds quicker. And so
yeah,
that was the preference there. The other thing that I think stood out. I mean, we've always seen that this is not equally used across races and things like that. But the one thing I think that did stand out was the use on different age groups was pretty similar. 18, they broke it down 18 to 34 and 35 to 54, and then 55 and over.
yeah,
The 18 to 34 and 35 to 54 were pretty close. They were
pretty
almost the
close.
same.
Yeah,
And so I think that shows a kind of a breadth across across the consumers. But it is this does not seem to be driven. You're right, as much by consumers right now. It seems like it's being driven much more by by institutions, and then for people that are offering services that want to get paid in stable coins.
yeah,
I mean, I told you I talked to some small businesses, and they were saying that even when they deposit cash, they don't get immediate access to it, and
yeah,
into a traditional bank. And this was a way to for people to get paid and have access to their funds right away. And so I think
yeah.
that's a really big deal.
Yeah, just an interesting counterpoint to keep in mind when you hear these sort of breathless proclamations from, various groups about how stable coins are gonna, take over, are gonna grow to like 4 trillion or whatever like that. Look, maybe it's gonna happen, but it's gonna be because of institutional adoption. Less than 2% of consumers are saying that they use crypto for payments in the US. That number's gone down again as the main takeaway there. Okay, Jimmy, let's stick with stablecoins
Yep.
and talk about our friends from Circle who are making waves. Let's put it that way, making waves.
Yeah.
We touched on this story way back when they announced their kind of intentions to develop their own layer one blockchain called Arc,
Right.
right? And if I recall, you were kind of skeptical, if not dismissive of that effort, saying, "Look, we don't need another layer one." But in conjunction with that, Circle this past week has said that they are considering a mechanism that would allow money to be refunded in cases of fraud or disputes.
Yeah.
So this would be on their own layer one, on their own blockchain. They may make it possible to reverse transactions involving USDC.
Yeah.
Now, of course, the reason, as I'm sure our listeners can surmise, for that being such a big announcement is crypto was premised on being immutable,
Yeah.
right? I mean, that was kind of one of the fundamental selling points. Circle is, in my opinion, acknowledging the current reality of our payments landscape, which includes reversibility and many people liking that fact. So,
Yeah, I think for
what are your
I think
thoughts here? I mean,
yes,
programmable money is programmable, right? I mean, I don't, people, so they're programming reversibility.
they're programming reversibility. I mean, I've programmed things where it can't be transferred at all, where I would send things that can't be transferred at all. But yeah, I mean, this reversibility, it does seem to fit very squarely in the that space, if you will, of traditional finance, right? I mean, right now in traditional finance, pretty much all kinds of transactions can be reversed, money can be pulled back from wires. You have a lot of those kinds of things that are going on, and it's to protect consumers at the end of the day. That's usually the reason given
Yeah.
for those kinds of things, protect different kinds of consumers, and it allows for, as you said, fraud and things like that, or just mistakes that you make can
Yeah.
be pulled back. And so I'm a little, I don't know, I'm not dismissive of it at all. I mean, I see where it's going. But the next thing, I mean, and this is, this is what we were just talking about. Is the next thing going to be, well, we're going to hold your money for a day?
Yeah. Yeah.
I mean, right?
Yeah. Fair enough.
That's the one thing when I saw that, because it was all over the place. I mean, there were like a lot of news stories on this,
Oh, yeah. It's huge.
and when I saw it come out, it was like, I don't know. I mean, this seems like we're going, we're going to have people holding my money overnight, or people holding it for
Yeah.
24
T
hours or
plus
something
one.
like
Yeah.
that. It's like, wait a minute. This is what I was trying to get away from.
Yeah, exactly. So you're not like reflexively opposed. You're just kind of maybe skeptical and have some questions. It
Yeah.
sounds like, which I
Yeah.
think is the right approach to kind of any type of new
You know me, I'm
story.
skeptical of everything, Lee.
As you should be. Yeah.
Yeah.
Well, you take the time to do your own research and then come to
I
your
do
own
try.
conclusions. Yeah. I want to get your thoughts, Jimmy, on actually the technology here and how that would work. And this was an FT article, so it doesn't get into all the details.
Right.
But the article says that payments could not be directly unwound on this new blockchain, which they're calling ARC, but instead they could add another layer in which parties could agree to make counterpayments akin to refunds on a credit card. So I guess you could send USDC from one address to another. If it was later revealed that that transaction was related to fraud, you wouldn't technically be able to force the recipient address to send it back, but you could essentially freeze that address or signal to the blockchain that those USDCs are no longer valid, and then you could issue new USDCs. And so essentially, no one would want to take would be willing to take the bad USDC. Is that right? I
Right.
mean, how like programmatically, like how do you build this into a blockchain? And the best you can explain it on a
Yeah. I
podcast
mean,
format.
I guess that what you could do, you would have to have some sort of a mechanism, some sort of a program ability that allows for you to, once a transaction is completed, for you to, put a marker on certain tokens, that would make them basically invalid,
Hmm.
because the tokens would still exist. You couldn't, you can't get rid of them. But what you could do is you could put a marker on those tokens saying these are no longer valid.
Gotcha.
And they won't be. Yeah, and as soon as that happened, then you couldn't use any off rails, because
Yep.
nobody would cash them in.
No one to take
So
them.
you
Yeah.
could have them, but they wouldn't be worth anything because you couldn't get out of them.
Yep. I
And
think that's probably yeah.
this would be different than, I think in fiat currency, because there could be nobody that could wash these for you. There would be no ability to strip this, these
Yeah.
markers off of it.
Yeah, I mean, they thank you for clarifying that, and that was kind of how I thought. The gentleman who kind of was talking about this is Heath Tarbert. He was the former acting chair of the CFTC. He's now Circle's president, I think is his title. So he has this quote in the article where he says that there are some benefits to the current system that aren't necessarily present. Um, and then he says that blockchains would be reversed provided that or the transactions could be reversed provided all the parties agree. Okay. Now, when he says all the parties, I mean, presumably one of the parties is the party that
Is
is
not gonna
committing the
is not
fraud.
gonna be agreeing to this.
Yeah,
Yeah.
exactly. So I was kind of like, well, that doesn't make a lot of sense because, yeah, I mean, one of the parties is a bad actor here. That's the whole premise of this initiative. So I have more questions. I'm with you. Like when we talk about all these blockchain projects and whatnot, I mean, most of them are so far removed from the Satoshi vision and how kind of the Bitcoin blockchain works. And
Yeah.
I think it's some like the terminology at this point is sort of obscuring more than it clarifies, just calling things blockchain because there's so many tweaks and modifications, right? But I think we're all anchored to like the original Bitcoin blockchain of, immutable,
Yeah.
right? Censorship resistant, all these characteristics. And that's really not what's happening in the institutional realm.
No, no, I think you're 100% correctly. It's not what's happening now. We have run very far past the original vision, which is I mean that happens, but we seem to have run far
Yeah,
past the original vision.
for sure. It's yeah, and that's fine. Like look, markets evolve. Markets will take elements of the technology that are useful, right? So I don't think that's anything to like bemoan. I mean, certainly, I guess if you're a Bitcoin maxi, like you have lots to
Yeah,
complain about. But from our vantage point, like that, that's just what markets do.
sure,
They take the bits that are helpful and discard the rest. But I think the problem is that, and we're still using terminology that's referencing like the original vision.
right.
That doesn't. Okay, Jimmy. The final story for today. We're sticking with stable coins here, and this is a bit dated, I guess, by crypto standards, right? Where the news cycle is very quick, and it was from earlier this month. Stripe, okay, payments giant Stripe. I think
Yep.
most folks are familiar with Stripe, and crypto investment firm Paradigm announced their plans to launch a new blockchain project designed for stablecoin payments called Tempo. Now, this is a separate legal entity, so I think they
Mhm.
are the main investors in it. But some of the partners, I mean, this kind of reminds me of the original Facebook Libra announcement in terms of the heavy hitters involved here, because Visa, Deutsche Bank, Shopify, Nubank, OpenAI, and Revolut are among companies participating in the initial design. The whole premise here is to make stablecoin payments faster, as fast as traditional payments. So Tempo
Right.
is targeting 100,000 transactions per second with sub-second finality, and fees are paid in stablecoins instead of native tokens. Okay. It's EVM compatible, and yeah, I mean, this is really a big announcement because when it comes to payments, Stripe is as big a name as it gets, right?
Stripe is pretty damn big, and when you have Visa jumping on the bandwagon, it's like, hey, I think I know where this is going pretty quick. Being
Yeah,
able to do you know, point of sale type of transactions on these with these kinds of partners. I mean, these are big partners in something like this. My first thought was, I mean, obviously Visa's jumping on the bandwagon because they could see themselves being pushed to the sideline a little bit
yeah, it's kind
by
of an
something
innovator's
like this. I
dilemma,
mean, a little bit of self preservation there, but
which is
um,
smart.
yeah, oh, absolutely, absolutely. If they see, to me, that's probably one of the bigger signs when you look at the partners who's jumping on this. And I mean, Visa doesn't want to be replaced, but if they're going to be replaced, they want to have a piece of that one too. And so,
Hmm.
to me, them jumping on this is very very telling.
Yeah, no, that's right. Hey, do you have time for one more quick story? Because
Yeah,
I got to get your thoughts on this.
the Swift
Do
one.
you No, the Tether one?
Okay,
All right. Do you think Tether is the world's most valuable private company?
no,
Well, they are raising funds at a valuation that suggests they are. So they are chasing according to Bloomberg, Tether is attempting to raise as much as $20 billion in a private placement that would value the company at roughly $500 billion, which I believe is higher than SpaceX and OpenAI. I might be wrong on that, but it would be right up there. And ByteDance, which owns
yeah,
TikTok. I don't really know what else to say other than this is crazy,
yeah,
crazy town stuff here. One, I don't know. I don't know why they need to raise money because they're swimming in money. So I don't know what they're going to use the $20 billion for when they have $20 billion, in profits per year. I mean, it seems like, I
right.
mean, on a per employee basis, this is the most profitable company in history. So I don't know. I mean, maybe it's an attempt to diversify for the owners here. They can get shares or something like
Maybe,
that.
maybe, maybe.
Yeah. So I don't know
I don't
what to
know.
make
I
of this
mean,
other than
I
I
I
don't
think
know.
it's
Like, it's what they want to do. Doesn't mean they'll do it.
Yeah, I mean, this is a lot like the paper that I just did, and we use Circle at kind of at the middle of it because they have a lot of public information on Circle from their S1, and so we used a lot of that information. But I mean, Tether's kind of in the same boat, right? I mean,
Yeah.
they're huge. They have a global network, but folks, I mean, if yields start going down, and this might be why, not if, as yields start going down, I
Hmm.
mean, these companies are going to get less profitable. They have to be. They only make their money one way, right? They make their money
Exactly.
investing your assets, and they don't pay those out. They don't pay those dividends out. So, hey, good for them. I mean, they found a model that works. But I'm just saying that maybe that's the reason behind this. It's kind of like when Circle first came out and the company was worth more than all of their assets combined. It's
Yeah.
like, how can that be?
Yeah. It's I don't know. It's just another marker that we might be towards the top of this crypto cycle. I don't know.
Well, I think So I wouldn't say crypto cycle. I would say, it's probably very telling about the outlook for interest rates, right? Because these are interest rate
Mm,
plays. I mean,
yeah,
people
fair
talk
enough.
about them being one thing or another. These are interest rate plays, folks,
That's a
plain and
good point.
simple.
Good point.
Stablecoins for stablecoin issuers, that's all these are. These are, there's nothing magic here. There's no bag of magic beans. There's none of that kind of stuff. These are by and large interest rate plays. Period. End of story. That's all they are. And I mean, traditional finance has worked like this for, a couple of 100 years now. That's what this is. And so, hey, good for them. They went out, they did it. They were able to market these things, which is fine. I mean, I have no problem with any of that. But I mean, when you see companies like this going public, you kind of have to ask
Yeah.
yourself, like you did, why? Well, I think they see the writing on the wall, and all of a sudden, if interest rates collapse, these companies are no longer profitable like this. They may still be
Yeah.
profitable, but not like this.
Yeah, I mean, Circle's market cap is around $30 billion. So to say, I mean, look, Tether is obviously more widely used than USDC, but not
Not
widely
not
enough to
20 times
justify.
more.
Yeah, not at all, my friend. All right, well, I appreciate your perspective on that, Jimmy, and everything else we talked about today. A lot of fun as always, and
Always.
looking forward to doing this the next time, my friend.
Cool. Have a good week, Lee.
You too, Jimmy.